Hello, I'm Dr. Harold Wong, and today we want to cover the contents of an article that was published April 4th, 2012 in the Arizona Republic. And this has to do with my series on advanced IRA strategies, including the Roth and the multi-generation IRA strategies. We've had a lot of questions that have come in from the readers, and I want to cover some of them today. Number one, can I have a multi-generation IRA with my company 401k plan? The answer is, in almost every case that I've seen, the answer is no. And here's why. The multi-generation IRA will throw off a stream of income to your heirs, typically your kids and your grandkids. Once you stop working for a company, you're not making them any more money. They absolutely don't have the computer systems or the willpower to keep track of paying out the right amount over the next 10, 20, 30, 40, 50, if you've got young grandkids, potentially for the next 80 years. So the answer is no, you can't do a multi-generation IRA with 401k funds unless you will roll them out into your own separate multi-generation IRA that you control. Second question, can I have a multi-generation IRA with the Wall Street institution that holds my current IRA? Well, some of them will allow you to have it, but most don't. It's for the same reason as we covered on company 401k plans. You've got to remember that most Wall Street firms don't have the computer technology or the interest to pay out streams of income for the next 20, 30, 40, 50, 60, 70, even 80 years to young grandkids if you and your spouse get hit by a drunk driver. Now, there was an article in 2007 in Forbes, it was titled something like Disinherit My Kids, where it basically covered the issue and the fact that even very good firms, well-known firms, do not allow a true multi-generation IRA. Third question, why hasn't my CPA explained this multi-generation IRA strategy to me? Well, Ed Slott is the nation's most well-known and most quoted expert on advanced IRA strategies. If you Google New York Times, Wall Street Journal, Barron's, Forbes, Fortune, he's always quoted. He and the New York Society of CPAs say that at most 1% of CPAs specialize in advanced IRA strategies such as the Roth and multi-generation IRA strategies. And I'll give you a concrete example of that. In September of 2012, Ed Slott and I were on the stage at the end of his 2-day seminar. He only holds it twice a year and it costs $2,000. Well, if you know anything about CPAs, they call themselves frugal, their friends call them cheap. Is your CPA always reaching out to cover the bill if a group of 4 or 5 or 10 of you are out for dinner? No, he's the guy everyone says, figure out the exact amount if the waitress won't give us separate checks. And one person says, well, I had the 2 martinis. The other person says, well, I bought the bottle of wine. The other person says, I only drank water, but I had 2 desserts. So that's what the CPA does. He doesn't pick up the check. So guess what? How many CPAs are going to spend $2,000 and fly across the country to Las Vegas or Phoenix, Arizona, spend 3 nights hotel, airfare, food, to learn about a topic if their clients aren't asking about it? Because if the clients aren't asking about it, they say, there's so many other things I got to learn, let me spend my money and get training in that. And at that seminar at the end of September 2012 at the Biltmore Hotel in Phoenix, there were only 120 that attended. There's about 10 to 12 CPAs, maybe 5 to 7 estate planning attorneys, and the rest were financial types like stockbrokers. But guess what? Right there, in there, if you look at the prospectus or the print, it says they're not allowed to give tax or legal advice. Whether you work with a realtor, insurance agent, stockbroker, financial planner, banker, it all says they're not allowed to give tax and financial advice, which covers the fourth question that readers have had. How come I don't get this advice from my stockbroker or financial planner? Well, those are 4 questions. And then the fifth, how do I use the multi-generation IRA to maximize the amount of income going to my kids and grandkids? Well, you do that by First of all, not spending it all. That's obvious. If you spend it all, there's nothing left. Second, you might add the Roth component. By adding the Roth component to the multi-generation IRA strategy, guess what? There's no required minimum distributions, so the sum or amount of money keeps adding and adding instead of being forced out by the IRS. And next, by using the multi-generation strategy, what we do, combined with the Roth strategy, we can multiply income dramatically. I'll give you an example. For the former city manager of Little Rock, Arkansas, that met the Clintons when they were all going to college, what they did is they took just $100,000, converted to a Roth IRA, added the multi-generation IRA strategy, and they have 4 grandkids aged 6 to 10. That $100,000, even if you only project a 4% earnings rate, which is very conservative, will become $840,000. Actually, in that case, it's a little bit more. $942,000 of tax-free income over the life of those 4 grandkids. Well, that's all we have for today. For more information, go to my blog site, drwonginvestorguide.com.